Margaret sits at her kitchen table in April 2029. She's 68 years old. She carefully opens her Social Security statement. Her monthly benefit was $1,976, but this month, something is terribly wrong. The check is only $1,923 else. Over $500 is missing. She calls the Social Security office. After waiting 1 hour and 45 minutes, an agent finally answers. Ma'am, the trust fund was depleted. Your benefits have been reduced by 28%. Margaret's hands start shaking. But I thought the new tax law fixed Social Security? The agent pauses. No, ma'am. That was just a temporary deduction. It expired last year, and it actually made the problem worse. Margaret hangs up. She realizes she's lost $1,800 a year in benefits. Permanently. And the tax break she got for 4 years? It's gone too. I am Edward, a senior policy analyst and retirement finance expert, and I need to tell you something urgent today. There is a Social Security tax break that millions of seniors believe is saving them money. But the same law that gave you that deduction is now draining Social Security's trust fund faster than ever before. The trust fund depletion date has been moved up by 1 full year. If Congress does nothing, automatic benefit cuts will begin in 2032. The Congressional Budget Office estimates those cuts will average 28% per year. For a typical retired couple, that's $18,400 per year in lost income. Gone. And here's the part almost nobody is talking about. The tax break expires in 2028. But the damage to the trust fund, that's permanent. Now I know what you're thinking. Edward, I've been hearing on the news that Social Security benefits are no longer taxed. I've been told this is the biggest win for seniors in decades. How can this be bad? I'm going to answer all of those questions, but I need you to stay with me until the very end of this video, because there is a hidden trap in this law that almost nobody understands. And if you don't know about it, you could lose tens of thousands of dollars in the next few years. I'm going to show you exactly what this law does, what it doesn't do, who it actually helps, who it hurts, and the 5 steps you must take right now to protect yourself and your family. Let's begin. Let me tell you about Robert. Robert is 67 years old. He worked for 42 years as a machinist in Ohio. He retired in 2024. His Social Security benefit is $2,100 a month. He also receives a small pension of $800 a month from his union. Robert lives modestly. He owns his home outright. He drives a 2015 Honda Civic. He doesn't take fancy vacations, but he's comfortable. In early 2026, Robert started hearing the news everywhere, on television, on the radio, from his friends at the community center. Congress just passed a law, no more taxes on Social Security. Robert was thrilled. For years, he had been paying about $1,200 a year in federal taxes on his Social Security benefits. He hated it. He felt like he was being taxed twice, once when he paid into the system, and again when he received his benefits. So when Robert filed his 2025 tax return in April 2026, his accountant told him about the new enhanced deduction for seniors. Robert qualified. He got an extra $6,000 deduction. His tax bill dropped by about $720. Robert was happy. He thought, finally, Washington did something right. He used that $720 to take his grandkids to a baseball game that summer. In 2027, he got the deduction again. Another $720 saved. Same thing in 2028. Over 3 years, Robert saved $20,160 in taxes. But Robert didn't read the fine print. He didn't understand what was happening behind the scenes. He didn't know 3 critical things. First, the deduction only lasts through 2028. After that, it disappears. Second, the law didn't actually eliminate taxes on Social Security benefits. It just gave him a deduction that reduced his overall taxable income. The old tax rules from 1983 and 1993 are still in place. Third, the same law that gave him that $720 annual tax savings also reduced the revenue going into Social Security's trust fund. accelerating the date when the fund runs out of money. Robert didn't pay attention to the news in 2026 when the Social Security chief actuary issued a report. The report said the trust fund depletion date had been moved up from 2033 to 2032. Robert didn't read the Congressional Budget Office projections. He didn't realize what was coming. Fast forward to January 2029. Robert files his 2028 tax return. He claims the deduction one last time, but his accountant tells him, "Robert, this is the last year for this deduction. It expires after 2028. Robert is disappointed, but he figures, well, at least I saved some money for a few years. Then, in late 2032, Robert starts hearing troubling news. The Social Security Trust Fund is running out of money. Congress is debating what to do, but they can't agree. Some want to raise taxes, some want to cut benefits, some want to raise the retirement age. Nobody can compromise. The clock runs out. In early 2033, Robert receives a letter from the Social Security Administration. Due to trust fund depletion, your monthly benefit will be reduced by 28% effective immediately. Robert's $2,100 monthly benefit is cut to $1,112. That's a loss of $588 per month, or $7,056 per year. Robert's wife also receives Social Security benefits. Her benefit is cut too. Together, they lose approximately $18,400 every year. Robert sits at his kitchen table. He does the math. He saved $2,160 in taxes over 3 years, thanks to the deduction. But now he's losing $18,400 every single year for the rest of his life and his wife's life. Robert feels betrayed. He feels like he was tricked. He calls his congressman's office. But the damage is already done. Robert fell into the trap. And right now, millions of seniors are walking into the exact same trap. Let me break down exactly what this law does and what it does not do. I'm going to go step by step. I'm going to show you the official government documents, and I'm going to explain this in plain English because this might be the most important financial information you hear all year. The law, One Big Beautiful Bill Act, Section 701103. This law was signed on July 4, 2025. It's officially called the One Big Beautiful Bill Act, or Public Law 11921. Section 70103 of that law created something called the Enhanced Deduction for Seniors. Here's how it works. If you are age 65 or older, you can claim an additional $6,000 deduction on your federal tax return. If you're married and both of you are 65 or older, you get $12,000. This deduction is on top of your normal standard deduction. In 2025, the standard deduction for a single filer was $15,750. For married couples filing jointly, it was $31,500. There's also an existing extra deduction for people 65 and older, $2,000 for singles and $1,600 per spouse for married couples. So with this new enhanced deduction, a single senior can now deduct $15,750 plus $2,000 plus $6,000, which equals $23,150. A married couple where both are 65 or older can deduct $31,500 plus $3,200 plus $12,000, which equals $46,700. That's a significant deduction. For many seniors, it means they will owe little or no federal income tax. Sounds great, right? But here's the catch. It only applies for tax years 2025, 2026, 2027, and 2028. After December 31st, 2028, it disappears forever. This is what's called a sunset provision. The deduction is temporary. The phase-out rule now, not everyone gets the full deduction. If your modified adjusted gross income, your MAGI, is above a certain threshold, your deduction starts to shrink. For single filers, the phase-out starts at $75,000. For married couples filing jointly, it starts at $150,000. The deduction phases out at 6 cents per dollar of income above those thresholds. It disappears completely at $175,000 for singles and $250,000 for couples. So if you have significant income from pensions, part-time work, rental properties, or investments, you might not get the full deduction, or you might not get any deduction at all. This is important because many of the seniors who are celebrating this tax break may not actually qualify for it. What this law does not do. This is the most important part, and this is where the confusion and the trap begins. This law does not eliminate federal income taxes on Social Security benefits. Let me repeat that. This law does not eliminate federal income taxes on Social Security benefits. The old rules from 1983 and 1993 are still in place. Let me explain those rules because this is critical. Back in 1983, Congress passed a law that made Social Security benefits taxable for the first time. Here's how it works. You take half of your Social Security benefits. You add that to all your other income, wages, pensions, interest, dividends, capital gains, even tax-exempt interest from municipal bonds. That total is called your Modified Adjusted Gross Income, or MAGI. If you're a single filer and your MAGI is below $25,000, none of your Social Security benefits are taxable. If your MAGI is between $25,000 and $34,000, up to 50% of your benefits may be taxable. If your MAGI is above $34,000, up to 85% of your benefits may be taxable. For married couples filing jointly, the thresholds are $32,000 and $44,000. Below $32,000, no benefits are taxable. Between $32,000 and $44,000, up to 50% may be taxable. Above $44,000, up to 85% may be taxable. Now here's the kicker. Those thresholds have never been adjusted for inflation. Not once, not in 1985, not in 1995, not in 2005, not in 2015, not ever. The $25,000 threshold from 1983 is still $25,000 today. If it had been indexed to inflation, it would be over $77,000 today. Because those thresholds have never been adjusted, more and more seniors are paying taxes on their benefits every year. In 1984, only about 10% of Social Security beneficiaries paid any tax on their benefits. Today, it's over 50%, and that percentage keeps growing. The new law does not change any of this. The thresholds are still $25,000 and $34,000 for singles, and $32,000 and $44,000 for couples. The 50% and 85% rules are still in place. What the new law does is give you a larger deduction on your overall income. That deduction might reduce your taxable income enough that you don't owe any tax. But it doesn't change the law that makes Social Security benefits taxable in the first place. The Social Security Administration made a mistake and had to correct it. This is where the confusion really started. On July 3, 2025, the Social Security Administration issued a press release. The press release said the new law includes a provision that eliminates federal income taxes on Social Security benefits for most beneficiaries. That statement was wrong, completely wrong. 4 days later, on July 7, 2025, the Social Security Administration issued a correction. They admitted that the original statement was inaccurate. The law does not eliminate taxes on Social Security benefits. It provides a deduction that may reduce or eliminate your overall tax liability, but it does not repeal the 1983 and 1993 laws that make benefits taxable. AARP immediately reported on this mistake. On July 8, 2025, AARP published an article titled, "What to Know About the New Tax Deduction for Older Adults." AARP made it very clear. The new tax law contains no provision ending taxation of Social Security benefits or changing how those taxes are calculated. But by that point, the damage was done. Millions of seniors had already heard the original incorrect message, and many still believe it today. Who this law does not help. There's another group of people this law completely ignores. Over 13.1 million Social Security beneficiaries are under the age of 65. This includes people who claim Social Security early at ages 62, 63, or 64, people receiving Social Security disability insurance, also known as SSDI, surviving spouses and children receiving survivor benefits, None of these people qualify for the enhanced deduction for seniors because you have to be 65 or older. So if you retired early and you're 64 years old, you get nothing. If you're disabled and receiving SSDI, you get nothing. This law only helps people 65 and older, and only those with income below the phase-out thresholds. Here's what's really happening to the trust fund. Now let me explain the part that almost nobody is talking about. Every year, when people pay federal income taxes on their Social Security benefits, that money does not go into the general treasury. It goes directly back into the Social Security Trust Fund. Specifically, it goes into two trust funds, the Old Age and Survivors Insurance Trust Fund, called OASI, and the Disability Insurance Trust Fund, called DI. In 2024, taxes on Social Security benefits brought in $55.1 billion to those trust funds. That's billion with a B. That money is critical. It helps keep Social Security solvent. But this new enhanced deduction for seniors reduces people's taxable income, which means less tax gets collected on Social Security benefits, which means less money flows back into the trust fund. On August 5th, 2025, the Social Security Administration's chief actuary sent a letter to Senator Ron Wyden. In that letter, the chief actuary analyzed the impact of the One Big Beautiful Bill Act on the Social Security trust funds. Here's what he found. The OASI trust fund was originally projected to be depleted in the first quarter of 2033. Because of this new law, that date has been moved up to the fourth quarter of 2032. That's one full quarter earlier. The combined OASI and DI trust funds were projected to be depleted in the third quarter of 2034. Let me put that in real numbers. If you're receiving the average Social Security benefit of about $1,176 per month, a 28% cut means you lose $553 per month. That's $6,636 per year, every year, for the rest of your life. For a married couple where both receive Social Security, the combined loss is approximately $18,400 per year, every year, for the rest of your lives. And remember, the tax break that caused this? It expires in 2028, so you get 4 years of tax savings, maybe $500 to $2,500 per year, depending on your income. Then the deduction disappears. But the benefit cuts, those are permanent, unless Congress acts. The deduction ends, but the damage doesn't. Here's the cruel irony of this whole situation. You get the enhanced deduction for seniors for 4 years, 2025, 2026, 2027, and 2028. Starting in 2029, when you file your 2028 tax return, the deduction is gone, your taxes go back up. But the money that didn't flow into the Social Security Trust Fund during those 4 years, it's gone forever. You can't get it back. The trust fund doesn't refill. The depletion timeline doesn't reset. The damage is permanent. You lose the tax break in 2029, and you face the benefit cuts starting in 2032 or 2033. It's a trap, a temporary tax break that costs you permanent benefit cuts. Why Congress did this? Now you might be asking, Edward, why would Congress pass a law that helps seniors for 4 years but hurts them for the rest of their lives? That's a fair question. The answer is politics. The enhanced deduction for seniors was part of a much larger bill. That bill included tax cuts, spending cuts, and policy changes across dozens of areas. The deduction for seniors was designed to be popular. It sounds good. No more taxes on Social Security. It gets votes. It gets applause. But it was never designed to be permanent, because making it permanent would cost too much. The Congressional Budget Office estimates that making this deduction permanent would cost over $1.2 trillion over 10 years. Congress wasn't willing to pay that price, so they made it temporary. They gave you 4 years, and then they walked away. And meanwhile, the same bill cut Medicaid by $911 billion over 10 years. It eliminated nursing home minimum staffing requirements, saving $23 billion. It made it harder for seniors to qualify for Medicaid coverage for long-term care. So with one hand, Congress gave seniors a small, temporary tax break, and with the other hand, they cut Medicaid, accelerated Social Security's insolvency, and set the stage for massive benefit cuts in just a few years. So what do? How do you protect yourself? Here are the 5 steps you must take right now. Step 1. Claim the deduction. If you qualify, but understand what it really is. If you are age 65 or older and your modified adjusted gross income is below the phase-out threshold, you are legally entitled to this deduction. Claim it. It will reduce your taxes for 2025 through 2028. That's real money. Use it. But do not believe that this deduction saves Social Security or eliminates taxes on your benefits. It does neither. It is a temporary tax break. Nothing more. When you file your tax return, make sure your tax preparer includes the enhanced deduction for seniors. If you use tax software like TurboTax or H&R Block, the software should automatically calculate it for you if you enter your age and income correctly. If you need help filing, contact AARP Foundation Tax Aid. They provide free tax preparation for seniors at thousands of locations across the country. Call 1-888-AARP now or visit aarp.org tax aid. The IRS also has a tax counseling for the elderly program called TCE. It provides free tax help for people age 60 and older. You can find a location near you by calling 1-800-906-9887 or visiting irs.gov. Both programs are completely free. Step 2. Adjust your tax withholding on Social Security benefits. Many seniors don't realize you can have federal taxes withheld directly from your Social Security check. This prevents surprise tax bills in April. You file a form called IRS Form W-4V, Voluntary Withholding Request. On that form, you can choose to withhold 7%, 10%, 12%, or 22% of your monthly benefit. The Social Security Administration will then send that amount directly to the IRS every month. When tax time comes, you've already paid. No surprises, no penalties. You can download Form W-4V at irs.gov, or you can call Social Security at 1-800-772-1213 and request that they mail you a copy. You can also visit your local Social Security office, though be aware that wait times have increased significantly due to staffing cuts. This step is especially important if you have other income like a pension, part-time work, rental income, or investment income, because that income combined with your Social Security might push you into a higher tax bracket. And if you don't withhold, you could owe thousands of dollars in April. Step 3. Keep detailed records of all your income and tax documents. This sounds simple, but it's critical. Keep copies of your Social Security statements. You can access them anytime at ssa.gov, My Account. Your 1099 SSA forms. These show how much Social Security you received and how much was withheld for taxes. Your pension statements and 1099-R forms. Your investment and bank interest statements. Your property tax bills. Your medical expense receipts. Why? Because if the Social Security Administration or the IRS makes a mistake, you need proof. And mistakes happen more often than you think, especially now when the SSA has lost over 7,000 employees and phone wait times are averaging over an hour. Store these documents in a safe place, a fireproof box, a filing cabinet, or scan them and store them digitally in a secure cloud service like Google Drive or Dropbox. If you ever need to appeal a decision, dispute a tax bill, or prove your income for Medicaid or Medicare, you'll have everything you need. Step 4. Understand your full retirement income picture. Most seniors have multiple sources of income. Social Security, maybe a pension, maybe a 401k or IRA, maybe part-time work, maybe rental income. You need to know exactly how much income you have, where it comes from, and how it's taxed, because different types of income are taxed differently. Social Security is taxed based on the formulas we discussed earlier. Pension income is usually fully taxable. Withdrawals from traditional IRAs and 401ks are fully taxable. Withdrawals from Roth IRAs are not taxable. Interest from municipal bonds is tax-exempt at the federal level, but it still counts toward your modified adjusted gross income for Social Security taxation purposes. Sit down with a financial planner or a tax professional. Go through your entire income picture. Understand how much you're receiving, how much is taxable, and how much you'll owe in taxes, and plan for 2029 when the enhanced deduction for seniors expires, because your taxes are going to go up. Make sure you're prepared. Step 5. Contact your senators and representative right now. This is the most important step. The trust fund will run out in 2032 or 2033. That is less than 7 years away. If you're 65 today, you'll be 71 or 72 when the cuts hit. If you're 70 today, you'll be 76 or 77. These cuts will affect you directly, and they will affect your spouse, and your children, and your grandchildren. Congress has the power to fix this. They can raise the payroll tax cap. Right now, Social Security taxes only apply to the first $168,600 of earnings. If you make more than that, you don't pay Social Security taxes on the excess. Congress could raise that cap or eliminate it entirely. They can adjust the benefit formula. They can means test benefits so wealthy retirees receive less. They can raise the full retirement age gradually. They can increase the payroll tax rate. They can dedicate other sources of revenue to the trust fund. There are solutions. But Congress will not act unless they hear from you. Politicians respond to pressure. They respond to phone calls. They respond to letters. They respond to votes. Go to congress.gov, enter your zip code, find your 2 senators and your representative. Get their phone numbers, call their offices, tell them, "My name is your name. I am a Social Security beneficiary in your city. I want you to pass legislation now to fully fund Social Security before the trust fund is depleted in 2032. Do not wait until benefits are cut. Fix it now. Make the call today. Not tomorrow, not next week. Today. Your benefits depend on it. And if you really want to make an impact, write a letter. Physical letters get more attention than phone calls. Mail it to their Washington, D.C. office and their local district office. Show up at their town hall meetings. Ask them directly. What are you doing to save Social Security? Make them answer. Make them commit. And if they won't commit, vote them out. This is your retirement, your financial security, your future. Fight for it. Here's the reality. You cannot rely only on YouTube to keep you informed about Social Security, Medicare, pensions, and other benefits. Changes happen fast. Rules are complicated. Deadlines sneak up on you. And the consequences of missing one update can cost you thousands of dollars. Or tens of thousands. I've been doing this work for years. I've helped thousands of seniors navigate these systems. And the number one thing I hear over and over again is, "I didn't know. I didn't know about that rule. I didn't know about that deadline. I didn't know I had to file that form." And by the time they find out, it's too late. The deadline has passed. The benefit has been reduced. The claim has been denied. I don't want that to happen to you. That's why I've created something specifically for seniors like you. It's called the Global Senior Alerts Official WhatsApp channel. This is not a group chat. You will not be bombarded with messages from strangers. You will not have to participate in discussions. It is a one-way broadcast channel where I send you verified, real-time alerts about you have the ability to demand action. And when millions of seniors stand up and demand that Congress fix Social Security, Congress will listen. They have to. Because you vote. And politicians want to keep their jobs. So claim the deduction if you qualify. Adjust your withholding. Keep your records. Understand your income. Call your representatives. Join the WhatsApp channel. Download the guide. Share this video. And stay informed. Stay protected. Stay strong. Thank you for watching. I'm Edward, and I'll see you in the next video.